Good afternoon, everyone, and thanks for joining us to talk about the potential impact of COVID-19 on the UK's regions. I thought I'd start with a quick summary of the outlook for the UK economy overall before diving into the regional data. So I put together this slide, which shows you some current expectations of a range of different official forecasters. Now, I don't think it makes sense to focus too much on the specific numbers. One of the things I mentioned in a recent blog post is that at a time of unprecedented uncertainty, we need to be very wary of attaching too much importance to point forecasts, because these numbers will inevitably be revised, not only as more data becomes available, but also as we get more clarity about the likely evolution of the pandemic and of the government's policy measures in response. In any case, the Bank of England and the OBR have both made it clear that what they've published are plausible scenarios rather than actual forecasts. So the main point that I'd note here is that the expectation at this point in time seems to be for a so-called V-shaped recovery, which you can see pretty clearly here from the chart, with a solid rebound expected in 2021 after a pretty shocking contraction in output this year. But whether that V-shaped recovery actually transpires will depend heavily on when and how the lockdown continues to be eased, but also on consumer and business confidence, even once restrictions on activities have been lifted. But today, we wanted to look at what this might mean for the different regions of the UK. Now, to begin, it's worth remembering that even in normal times, pre-pandemic, economic performance varied quite widely by region, as you can see here. Now, this chart shows you the annual average growth rates in the regions over the last 10 years. And when we look at the economic structures of the regions, we find that they're actually relatively similar in terms of the key service sectors that will drive the COVID-19 economic impact. So the TheCityUK is, of course, the industry body representing financial and related professional services. And so in this presentation, I'm focusing on services and not really covering manufacturing and industry. And we should remember, too, that services account for 80% of UK GDP. So what we did in this chart was to combine the sectors that are being most directly affected by the crisis. So that's retail, transport, accommodation and food service, and education. And then we calculated the GDP of these combined sectors as a percentage of each region's total GDP. And you can see that the figure is roughly 25% of GDP in each region without too much variation. However, if we look here at the employment contribution of those same sectors, we see that the picture looks quite different. Those sectors' employment represents nearly 40% of total employment in regions like the South East, the South West, the East of England and the East Midlands, but just over 30% in regions like London and Scotland. Now, what this means is that the evolution of government policy is going to be critical in terms of supporting demand. As I wrote in a recent blog post on this subject, it would be reasonable to assume that the regions that rely more heavily for employment on extremely vulnerable sectors are likely to be hit harder by job losses in due course. And in terms of what that means for overall growth, we have to remember that consumer spending accounts for fully 2/3 of the UK economy. Now, given the pretty wide regional variation in average income, the fact that the government's income support for furloughed workers is capped at £2,500 a month means that a higher proportion of furloughed workers in regions outside London and the South East will receive the full support at 80% of salary. Since this has been crucial to supporting consumer spending, a key question will be how and when that furlough scheme is tapered off. So we know now that it's being extended until October, 4 months longer than initially planned. But since the worst of the economic impact of this crisis is still to come, the level of income and employment support going forward is going to remain a key question. And this emphasizes the importance of considering again how further devolution could help ensure that all UK regions have a supporting, enabling environment in which the businesses that survive this crisis and the new businesses that have yet to be created can all thrive. We hope that in due course, government will be able to provide clear recommendations with respect to further settlements for city-based or sub-regional decision-making. Ideally, devolution should also allow for the creation of labs, for policy, and the possibility of examples of successful innovation being shared between clusters. But turning now to financial and related professional services specifically, you can see here that financial services is expected to be among the least affected sectors from this crisis. Now, this table was produced by the Office for Budget Responsibility, and it takes into account, among a number of other things, the ability of employees in each sector to work remotely, which is something I'll come back to in a moment. Now, the Bank of England's latest monetary policy report, published earlier this month, included survey data for the current quarter showing a similar trend. But the breadth of concerns within the industry is wide. It ranges from the impact of COVID-19 on financial markets and the business environment to the effect of the crisis on rents, because after all, many financial and professional services firms are also commercial landlords. So, although it's too soon to try to measure the impact of the crisis on the industry in a comprehensive way, I did want to highlight the TheCityUK's annual research quantifying the contribution that financial and related professional services makes to each UK region and nation. So here you can see the spread of that contribution, which we measure by industry, employment, and GVA. We have reams of detailed data, which you can see here. We break down the industry, employment, and GVA by regions and cities and even constituencies. And we also look at trends in the different subsectors of banking, insurance, fund management, and legal and accounting and management consulting. Now, I know you won't be able to read all of the detail on this slide, and obviously we don't have time to go through all of the data here and now, but if you are interested in the detail, I just wanted to present a kind of snapshot of what we've done. So if you are interested in the detail, please do get in touch after the webinar. One important thing to note is that the data are for 2018, which might seem to you like, oh, this is very out of date, but that is actually the latest published data from the ONS. And inevitably the question on everybody's lips is, oh, well, how are the pandemic and the recession going to affect the industry? So while we're covering some of the broad themes related to that question here and now, the impact won't actually be reflected in the official data for quite a long time to come. So just, by way of example, we've only just had sight of the data for the first quarter of this year, very recently. And that showed that the services sector was the biggest contributor to the overall economic decline. The services sector accounted for 1.6 percentage points out of the 2% quarter-on-quarter decline in Q1. And actually, it's worth remembering that activity was normal for most of Q1 since the lockdown only went into effect at the end of March. What I would say, though, at this early stage is that the snapshot of industry GVA across the UK is basically that financial and related professional services accounts for 5 to 10% of total GVA in every region of the UK, except, of course, London, where the percentage is much higher. When the 2020 and 2021 data are released, I think we might expect to see those percentages increase slightly, and that would reflect the expected economic contraction and a slight reweighting of some of the components of the economy, given that the pandemic is affecting different sectors quite unevenly, as we saw earlier. But I wouldn't expect these basic structural features to change significantly in the medium term. One area where we might see longer term changes, though, is in productivity. Now, I've done some work previously on financial and related professional services productivity in the different regions, but I do think it's a little early to consider how the pandemic might change some of the trends that we see there. But one idea that I think is worth exploring is whether a longer term shift towards remote working might increase industry productivity, but also potentially alter some of the regional employment patterns that we saw on the previous slides. After all, remote working opens up the possibility not just of working from home in the city or region where your employer is based, but also working in a completely different part of the country. So, for example, Deloitte's CFO survey just recently indicated that 98% of CFOs expect to see flexible working increase as a result of the crisis. But I wanted to take this opportunity to ask all of you, our viewers, a question along these lines. So we have a very short one question online poll, which we'd be very grateful if you would complete now. You will see the question pop up here in a moment, and it is your own company likely to increase remote working options after the pandemic? So I'll pause for a moment to give you a chance to record your response, yes, no, or not sure. And we will come back to the results later in the webinar. Hopefully we'll have those results tabulated in time to cover them during the discussion part of the webinar. But one immediate thought that I had is that an increase in remote working might actually reshape the landscape of industry clusters, which our research shows currently looks like this. So what you see here are towns and cities where particular industry subsectors have employment of more than 5,000 people. So as an example, Swindon has more than 10,000 financial services jobs, but fully 6,000 of those are in banking. So we would call that a banking cluster. And obviously some cities have multiple clusters. But I know as well that that is a topic that the Centre for Cities has also done quite a lot of work on. And so I thought that that might be a nice segue into the next part of this webinar. So with that, I hope that's been helpful. But let me end my own remarks there and hand back at this point to Miles. Thank you.